everyone, greetings and welcome to Nazariya, an interactive session with JM Financial Mutual Fund. We are so glad to have you all on this call for this conversation today. It's my pleasure to introduce Mr. Satish Ramanathan, CIO Equity, JM Financial Mutual Fund. He comes with 3 decades of rich experience in asset management, including equity research. We also have Mr. Asit Bhandarkar, Senior Fund Manager Equity, who comes with 20 years of experience in the equity research and fund management. Today, we will be discussing about equity markets. Without further ado, I'll hand over the call to Satish sir and Asit sir.
Hi, good afternoon, ladies and gentlemen. Welcome to our monthly Nazariya. In this session, we have the pleasure of presenting the budget highlights as well as what's happened in the market and also focus on our strategy, portfolio strategy, and our current thoughts as of now. As regards the budget, as you are aware, the key accent of the budget was to shift away from capex and focus on consumption. So what you can see here is that there's been a cutback in atomic energy, in telecom, in defense, and there's been a shift to on transfer to state and union territories, which means local capex is receiving a boost, such as water and local state highways. And also railways has got a paltry 3.3% increase, which is not very meaningful. So to some extent, that has been a disappointment. But the relief has come in terms of lower income tax for salaried income. And most of this salaried income people would be in the mid-corporate or government sector, and consequently the benefits can be fairly significant. As it was stated in the budget, it was about 1 lakh crores or 1.1 lakh crores relief given to the taxpayers, which will start trickling in from April of this year, not March, April of this year. So that's when the salaries start going up to some extent. And we will start seeing some benefits trickling in post that. As you can see, there's been a bit of a slowdown across several sectors. If you look at coal, the rate of growth has declined. Crude oil, the time passes. In the next slide, manufacturing and services continue to do reasonably well. Manufacturing, there's been a slight uptick in recent months. Services has always been reasonably strong. And we think that with growth coming back, both these segments of the economy will do reasonably well. We expect private final consumption expenditure, which had materially slowed down, to revive. And I think that's where the government thrust is also because of lower taxes. Credit growth has been very sluggish over the past 2 years, in fact 3 years, because primarily because the leverage in the system has come down, and also most people are preferring to use equity as a route to fund their capex. The credit deposit ratio is also a little high, meaning that the headroom for growth is also limited. Most banks are actually of the view that they are going to focus on consumer credit, which the RBI is against. So bank growth will remain probably in the mid-teens, not meaningfully higher. As regards our currency has depreciated by about 5% on a one-year basis, which is in line with the Japanese yen or the euro or any other currency. So I think that's something which will probably continue as India tries to reduce its interest rates and loosen liquidity and improve liquidity. So the currency would be the fallout of this venture. And as you can see, our forex reserves has also dropped meaningfully. Because of the defense that RBI took, and also because of continuous selling and our trade balance being in deficit. But having said that, we are probably back to May 2024 levels of forex, which is not something to be alarmed about. And I think that's something which will start picking up once the currency stabilizes. In the next slide, if you look at the real rate, the CPI is coming down and the real rate is slightly high, which means that the government and the central bank have room to reduce the interest rates further. And so just the basic thing, reviving consumption, consolidating the fiscal deficit, and also ensuring that the capex continues, though the momentum is lower. These are the three takeaways from the union budget. In the next slide, we just wanted to highlight the 4.4% fiscal deficit in 2026 and how the subsidies are coming down. Markets were challenged in January, especially the small cap, which declined by almost 11%, and Nifty by about 0.6%, and mid cap at 150 at about 6.1%. FIs continue to sell down. For the month of January, they sold almost 72,000 crores, 73,000 crores, which is significant. And that actually impacted the market sentiment meaningfully. The best performing sector was just auto, primarily because of this consumption thrust and growing commentary that rural India is picking up. So that's one. And in terms of tariff and impact, right now, as we are aware, Prime Minister Modi is meeting Mr. Trump. So we need to see if we get by without much punitive tariffs. The US has highlighted that India has one of the highest tariffs in several categories of products. India will need to rationalize that quickly, as well as allow a kind of bilateral trade to improve. Structurally, India is well positioned to take benefit of this opportunity because we have cheap labor, we have growth and potential to export, especially textiles, iron and steel products, auto and engineering, pharma, IT, all of these goods, all of these aspects are favorable for India, but we need to ensure that tariffs are not dumped on. Valuations, while aggregate market valuations have not declined significantly, stocks have declined significantly by 25 to 40%, which is an opportunity for us in the medium term. I think the sharp decline in consumption momentum will be reversed and earnings momentum will also pick up. So corporate earnings, in our view, will start improving from here on as the adverse base is turning favorable. In Q3, based on the results declared, the YOY growth rate is just about 8.4%, but significantly higher than the 4% that we had in Q2 of FY25. And overall, our portfolios were impacted by several cross currents. We are changing our allocations to factor in the newer realities of slower capex and higher consumption growth, aided by financial leverage as well. So what we have done is we have increased allocations to consumer discretionary and reduced our industrials and increased our financials weight as well. Overall, there has been significant volatility, but we are taking it a step at a time. And we have increased our large cap allocations to ensure that the volatility is reduced as well. With this, Asit, would you like to take it forward?
Sure. So broadly, I think Satish, you have sort of given a broad picture of what our thoughts are. Clearly, I think to summarize your thoughts, we have as a fund house recognized the fact that the capex momentum is slowing down. The tailwinds which existed post-COVID for capex have come off. We do recognize that in India, private sector capex is yet to take off, so the opportunity has interimly come off as government has stepped its foot off the accelerator. But the larger opportunity may still be there, but more selectively than it used to be in the last few years. But that also, I think what the budget shows us is that the consumption opportunity, which has been the larger India opportunity, if you will, over the last 2 decades, is probably now going to take over. And to that extent, I think whatever steps have been taken in the budget, and also the fact that some of these stocks have had a very rough time over last 3-4 years uh, puts us in a very favorable position to consider some of these names. And to that extent, the tilts in our portfolio have already happened. We have moved our portfolio substantially towards consumption, and we hope to benefit from this tilt as we step into 2025 incremental few months post the current phase of volatility, which may just last a few weeks. And as more and more clarity on global macro uncertainties is available, I would think market will start focusing on the core fundamentals which are there, uh, which are actually now positive for consumption.
Thank you, Satish sir. Thank you, Asit sir. It was indeed an insightful session. Thank you everyone for joining today's Nazariya. We look forward to see you next month as well. Thank you. See you. Have a great evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.